Welcome, everybody, to this week's podcast episode for the Financial Freedom Podcast. I am your host, Dr. Christopher Liu. As you know, I talk about 4 different types of freedom: time, financial, location, health freedom. In that light, I'm always interested in scouring the globe for entrepreneurs, creators, influencers, bring you the cutting edge ideas, inspiration, knowledge, tools, tactics, and strategies. And in that light, we have our guest today is Mel Lieber, and he's a premium finance specialist, retirement and estate planner. And as a quick disclaimer, none of this is financial advice. This is for educational, entertainment purposes only. Nothing is vetted, so do your due diligence. So we'll bring on Mel, and welcome to the show. Welcome.
Well, thank you, Chris, for having me. I really appreciate it. Always happy to talk, and you sound like it looks like a great show to be on.
Yeah, what's interesting is we connected through Podmatch. It's a great way for guests and hosts to connect. And tell us more about yourself and premium finance, and we'll go from there.
All right, sure. So my name is Mel Lieber. I'm married with 5 kids. I started my own business called Finance Premiums. I am like one of those real number guys. I eat numbers for breakfast. I don't get scared by math. I just love it. I guess that makes me a little bit of a geek, but I think I'm still a pretty cool geek. So, I grew up in a real finance family. When I was like an 8-year-old, I would be like, oh, I have my stocks every day run to the New York Times to check my little ticker. If you're under 30, you don't know what I'm talking about. Check the little ticker to know how my stocks are doing, because I overheard when my father was discussing with my older brother, and I just decided my stocks are, and that's how I kind of grew up. And, as it turned out, my family, we all were success in finance. My oldest brother has a hedge fund. My sister is a financial planner. My other brother is a day trader in a fancy Fifth Avenue firm. And thank God I do premium finance, which is an amazing way to help people save for retirement and an amazing way to help people plan their estates. So that's how I got to where I am.
Interesting. It's I always love this people when they grow up, they have all these different childhood experiences, like Bill Gates was with computers, and then and it's just fascinating. I was always fascinated with growing businesses and hustling, and it's great because you develop all this like street knowledge. So first thing is tell us about what is premium finance. Tell us what it is.
Okay, so what premium finance is, the reason actually most people don't know what it is, but the ultra high net worth, they all know what it is, because it's a strategy that used to be pretty much reserved for the ultra high net worth. The way that it works is we take a insurance product that is a high earning insurance product. I like to call it like a cousin of whole life. It's the same type of idea of this insurance product that can be used as an investment, but it grows at a higher rate than whole life policies. It's not as guaranteed, but the rate of growth is much higher. And then what we do is similar to a real estate investment, where you don't usually buy a building by putting $1 million building by putting down $1 million. Rather, you put a $250,000 down payment and you get a $750,000 mortgage, which is able to make your growth much, much higher than just buying a $250,000 building. We do that same thing with this insurance-based investment. Somebody puts down $250,000. We have bring in a lender that's going to put in $750,000, and now you have $1 million working for you instead of just $250,000. And it's just that model, which in real estate is obvious, applying it to life insurance, which is a relatively more safer asset class and better tax rules.
Interesting. What's in? Why do they? One question from the audience may be, why do they call it premium finance?
So really the annual contribution, the annual investment towards your insurance policy, which is your personal investment really, is called a premium, your annual premium. So instead of just going and paying it all out of pocket, we're going to actually finance somewhere between 75 to 100% of those premiums. So we're taking your premium and we're financing it.
Hmm. Okay, interesting. And when you say so this concept with premium finance and you apply it to you've mentioned real estate, life insurance, are there other different investment vehicles that you use premium finance for?
So personally, I only work in the premium finance space of these life insurance based investments. Well, that's actually half true what I said, because that's all even that I get paid for. Now, the way that it works is once my clients understand my financial knowledge. So once I'm doing that for them, then all of a sudden, all these real estate deals hit my desk. Could you mind going over the real estate deal? Tell me if I should invest in this. Then I have to say, listen, I don't claim to be a professional in this, but I kind of know how to do it anyways. So I help out my clients with that. Here's my non-professional opinion, and everything else is business. I end up getting in the market. End up getting very involved in lots of other fields. But my only, what I'll call professional specialty, is using this strategy in the world of a life insurance-based investment. However, in the world at large, it is very much used in stock market. We call it in the stock market investing a margin loan is the term usually used. In real estate, the term used is a mortgage or leverage. And in venture capital funds use it as leverage as well to increase their investments. So really it's used all over the place. Maybe we give it different names in different industries, but my personal specification and my personal expertise is in the life insurance side of things.
Hmm. And I know there's different types of life insurance vehicles. So educate the audience on how these investment product work, because one is like premium, and then other ones that acts like a savings. You can, you can tap in it when you need to. For example, if you want to make an investment or some other need. Tell us more about those life insurance.
Sure, my pleasure. Okay, so there's two categories of life insurance. The first category is a term insurance, term policies. Now, a term policy is very similar to your car insurance. If you don't crash, then you don't get anything out of your car insurance. Does that mean that it was money that wasn't well spent? No, it was money that was spent very well. It just happens to be, since you didn't crash, you don't collect on that. And most people are happy that they don't crash. That doesn't mean that it was not money well spent. So a term policy is like that. If somebody dies young, dies prematurely, they will get a big payout. They're very cheap usually, especially for the younger crowd. And if something, God forbid, happens, those that depend on you will be able to be paid out from the funds that are supplied from the insurance company. And once again, most people, and it's really shockingly 99% of people, put in money to the term policies and don't end up collecting anything, because they're only going to give you the policy during the amount of time that the actuaries say you're going to live. So therefore, that's how it usually works out. And I think it's for somebody that has people that are depending on them. If you do not have the other type of insurance, which I'm going to discuss in a second, go get that type immediately. Because I think it's a moral requirement, in my opinion, for any some father or whatever it is that have children depending on them, that they should have such. Now, the other type of insurance is a more sophisticated type, which it acts not only to provide the protection that I discussed previously, but in addition, it works as a tax shielded investment. Now, just like in the world of investing, there's different types of investing. There's bonds and there's stocks, for example, just to keep it as simple of a comparison as could be. Now, what gives you a higher earning? Putting money in the stock market will earn you a higher rate of return than putting money in the bonds. Does that mean bonds are bad and useless? No, they're not bad and useless, but they just perform a different function than the stock market. So the classic whole life policy is more similar to a bond type investment. It's dependable, it's predictable, and it's going to get you that 4, 5% return that some people are looking for. There's another type of investment that you could do with an insurance company called the IUL, which stands for Index Universal Life. And this is really what I specialize in. Doesn't mean I don't do any of the other types, but this is what I specialize in, which your return is some years you're going to get a 0 return. Some years you're going to get a 12% return. It's usually going to average out to 6, 7, 8%, depending on the time in history, your type of return, which is going to be pretty significantly above the whole life return, but not as predictable, not as guaranteed. But over the long term, assuming that is structured correctly, you're going to have a higher rate of return than a whole life policy. Similar to if I would tell you, if you put money in the stock market over a long period of time, you're going to get a higher return than bonds. That doesn't mean that a 75-year-old necessarily should be putting 100% of their money into the stock market, even though in the long term, your return will be higher.
And when you say the IUL, those are indexed to the S&P or Dow Jones, or what is it?
That's your decision. There's going to be a list, depending on the company, between 4 and 10 different options. You could go for the S&P 500. You go for a European index. You go for a global mix. You could go for something called nowadays, which is very common, a low volatility index, which I think that the reason why that's better might be a little bit beyond our conversation today. But the short idea is when there's lots of volatility in the market, you're going to get a higher return with a low volatility index, and you have the ability to change it from year to year. That's what you need: expertise, expert guidance to help you decide which index is right for you in each individual year. Yes. So that you have to really ask that expert.
And then what sort of fees are associated with each of the?
So that's great. Yes. So when it comes to, and this, by the way, is part of the bad rep that life insurance often gets, and it's often well deserved. Sometimes not. So sometimes not, sometimes yeah. Like an IUL, for example, what I very much like about IUL is it's a very flexible product. Mm-hmm. Which what we mean by that is, let's say your minimum investment for this year is going to be $200,000, right? Or let's look at smaller numbers. Most of the people listening probably that's a higher number. But I'm just speaking to somebody today. But okay, let's move it down a little bit. You're going to put in $30,000 a year is going to be your minimum. $20,000 a year is your minimum investment. Now, you could put into this product up to $80,000 a year. Mm-hmm. So off the bat, your natural reaction is, why would I want to put in $80,000 when I could put in $20,000? But actually, from an investing standpoint, in terms of rate of return, it's actually the inverse. It's actually the opposite. I'll give you an example which everybody understands. If I take $100 out of the ATM, and the ATM charges $3, so that works out to be a 3% fee, which that's a hefty fee, 3%. If I went to the same ATM the next day and took out $300, and they charged me the same $3, now it's no longer a 3% fee, it's a 1% fee. So the fees are going to be more or less standard. It's not exactly true. You can hold it to me to the T, but just conceptually, the fees are more or less standard. Mm-hmm. So when you stick in the max amount of money, what we like to call a max funded IUL, when you put the max amount of money, the fees are actually quite low in the long run of the policy. If you put in the minimum amount of money, the fees are very high. Mm-hmm. So usually, especially if a young person puts in the max amount of money, which is what I almost always, not always, because there are different cases, but what I almost always advise my clients is putting that max amount of money, even if it means I'd rather get you a smaller policy and make less money. I'd rather you get a smaller policy and do the max amount that you're allowed to in that policy than a bigger policy and not maxing it out, because your fees are going to be significantly lower when you max it out. Usually over the life of the policy, mm-hmm. we're talking especially for a young person, we're talking about, if we view it like we view it regular investing, accumulation fee, how much you pay your money manager, you're talking about under 0.5% fee.
Interesting.
Which is very reasonable in the money management world.
Yeah. And then what's interesting, so it sounds like you're basically like these are paper contracts, and it's almost very similar to like a stock, but it's a it's a life insurance policy. It's like a contract. So a lot of the audience listening to the counterparty risk is the issuer. Are these like hedge funds? Are these banks? Like, what if they go under and then they can't pay out the, tell us
So that's
more.
a great question. That's a great question. The issuer is going to be one of the large insurance companies. I only use, I'll not everybody, this isn't true with everybody, but with me at least, in my guidelines that I've personally set on myself, is that I will only work with a A-rated insurer plus. All the insurers that I work with, they've all been around for over 100 years. A lot of them have been around, like the company that I like working the most with, National Life Group, they've been around since 1840. They have like $40 billion in under management. They're a Fortune 1000 company. Does that mean it's impossible for anything to go wrong? No. But their track record is great. Now, furthermore, if something would go wrong, there's something called the state guarantee fund. So whichever state it's issued in, that state guarantees to back up the policies. So therefore, you're pretty much covered by the state government. Now, you may want to ask, well, what if the state government goes under? Well, they're backed by the federal government. What if the federal government goes under? I don't know. Your next currency is going to be tuna cans and toilet paper.
Yeah, which is, so basically, you have very stable institutions, backed by state, backed by federal, so, and then so what types of is it like is all high net worth individuals accredited investors? Do you see that they have some component of life insurance in their portfolio, or is it just like tell us more about the investor profile of these.
Okay, so I'll tell you the historical investor profile and the new age investor profile.
Yeah.
The historical investor profile of this concept has been people that have had issues with paying estate taxes. So we're talking about people that have a net worth above, using current numbers, $11 million individually, or if it's a couple, $22 million. That's where it starts. But even the person that has $22 million don't have a problem yet. So that's people that are worth more than that. So we're talking about historically, this has been for people that have real high net worth, 30 million and above, have estate tax issues, and they don't want to. The best way to deal with estate tax after you're done with the complex legal work that the lawyers could arrange for you, when you get beyond the gifting and beyond the family limited partnerships and etc. and all the other fun stuff and all of the different types of trust work that you could do, and you still have a problem. So this was always a great way to go about it, because you get a tax-free growth. It grows outside of your estate, and it's going to come in to pay the estate tax, the death benefit, at the perfect time that you need it, death. So it all clicked together very well. Now, there's been a new age application, which I was at the forefront working with in the last 8 years, to use this concept for the high earners, not only the high net worth, but also to use it for the high earners to set up a retirement plan. We're usually talking about people that make $200K a year and above, who are willing or capable of putting away at least $20,000 a year. That's the starting point. Now, most of my clients are putting in more than that. But that's really where it starts. And for these people, compare it to your average 401k options or IRA options, and you just can't compare. This will totally blow them out of the sky. As I like to say, it makes your 401k look like watching TV in black and white.
Yes. Yeah, I saw that, and it's quite interesting, because I was talking with another guest, and they were saying, especially with life insurance, especially the well, insurance is kind of like an option. It's like, it's a put, it's basically for calamity, but you can actually use it for investment purposes. And like the super high net worth, they know, the risk of probability of death is 100%. So they, right when their kids are born, they, buy life insurance. And, so this is the kind of the way the rich think. So that's interesting. A lot of people are.
And I would even add one thing to that. And most of the high net worth love using leverage.
Yeah.
A lot of the we'll call it, I don't want to use the word poorer. I mean, the lower net worth people. A lot of the they view debt or leverage, loans, whichever term you want to use, with like they're afraid of them. I don't want to be in debt. Dave Ramsey says it's bad to be in debt. And I agree, it's bad to be in debt that you don't have a clear, planned out. To go be in debt, to spend money on the credit card, to go on that vacation you can't afford, very bad. We all agree. But when debt is a calculated investment vehicle, it's actually very, very powerful. The best way to make money is other people's money.
Yeah.
And therefore, that's what the wealthy really understand. And therefore, once you start explaining to them the idea of we're going to get loans to make more money, yeah, sure, that makes perfect sense. Some of the people that aren't high net worth are less accustomed to that mindset, and for them, it's a little bit scarier.
Yeah, and it's interesting, you know, especially with debt, because the currency is getting devalued with inflation, and and then basically you're paying debt with other people's money, but also you're paying the debt with lower valued currency. So it's, but like I said, it's like different way of thinking, rich versus the middle class type of thinking. So
I'm here to try to teach the middle class or middle upper how to think like the high net worth. That's part of what I do.
Exactly.
I let them into the secret.
Yeah, it's interesting. A lot of people are interested in following you, visiting your website, contacting you on social media. How can they do that?
All right. So definitely what they could do is they could check out my website, which is www.financedpremiums.com. That's financed with the D at the end, premiums with the S at the end.com. Or they could email me, Mel, M-E-L, at financedpremiums.com, FINANCED, premiums, PREMIUMS.com. And that's the best way to get a hold of me.
And for all the listeners out there, this was a fantastic discussion. This is really how the rich get richer, like the mindsets, the way they think about different products, risk, especially risk asymmetry. And so be sure to check out Mel's resources in the links in show notes. He's on LinkedIn, his website, as well as financedpremiums.com. And what a fantastic discussion. And I'm really happy to have the quality guests on my show. So thanks so much. And thanks for coming on.
My pleasure. Thank you.